Mark from Caliber Home Loans. Hope you had a great week. We're going to go ahead and look at the mortgage market that ended on the 13th, for the weekend of the 13th, talk a little bit about programs, where rates are, and where we expect rates to go. So let's go ahead and dive in. So here we're looking at the bond chart for the 2.5% coupon for Friday. So it looks pretty choppy. It was an interesting day. There are lots of twists and turns. The Fed is still buying a ton of mortgage-backed securities and commercial paper also, and they expect to continue to doing that for some time into the future. So that will keep rates stable and maybe even drop a little bit. So this is what Friday looked like. We ended up a hair, so the price ended up a hair lower than where we started. So that's actually good for bonds, or I'm sorry, bad for bonds. It pushes the rate up. Remember that the price and the yield run in opposite directions, so the pricing got a hair worse from the open, but overall it was pretty even day. So let's go ahead and look at last week. So you'll see that there is a marked increase in the price of the bond from Monday through Friday. So again, this pushes yields down. So we ended up the week with pricing a little bit better. So rates either came down, or if we were charging points, those points would become less. So that's how it worked, and it's good to see that. And again, the Fed is in there buying as much as they normally are. And then let's go ahead and look at the last month. So you see this huge drop was from the jobs report. So that was a week ago Friday. So when the jobs report came out, and instead of losing jobs, they added 2.5 million jobs. What that does is normally that's good news on Main Street, so it's bad news for bonds. It's considered inflationary. So the initial knee-jerk reaction was for bonds to take a hit. So the price took a hit, which drives the rates up. But the Fed went in and started buying bonds, and it went back, and so the pricing started to increase, which brought the rate back down. So it kind of evened it out a little bit. Pricing did get worse a week ago Friday. And then you can see that from then on, it got kind of, it's been on the price has been on an upward trajectory, which is keeping rates low and bringing rates down a little bit, depending on the program. So this is pretty much the case for both conventional loans and government loans. So let's take a look at what next week has to bring. So for next week, the important there's a lot of news coming up, but the stuff that's really if it's going to move the bond market, and again, some of the stuff should move the bond market more than it is, but the Fed's in there buying a ton of bonds every day, so that kind of evens out the effect. But the retail sales is always a big deal. They expect retail sales to be up 7%, so we'll have to see how that works with different states opening up. And remember, this is national. Housing starts, they expect at 1 million, just over 1 million. In housing starts. So, for most states, the construction guys are back to work. If those states that they stopped, like in Michigan, they stopped for a little over 2 months. So everybody's back to work. So they're building houses, and that gets the builders to go in and put in permits to build more houses. And the weekly jobless claims is always a big deal. They expect it to be a positive, to gain 1.4 million. So we'll have to see how that all works out. The other news is still important, but it's not quite the mover that these particular three items are. So we'll have to see what happens. But those, so Tuesday, Wednesday, and Thursday, if there's going to be a shakeup in rates, I would expect it to be on those 3 days. So let's go ahead and finish up and talk about programs a little bit. There really hasn't been major changes anywhere in programs that I've seen, whether it's with Caliber or other lenders. Cash out refinances are still an issue for a lot of lenders, just because of the way the Fannie and Freddie has restructured the purchasing of those loans. So that can be an issue for certain people that are looking to do a cash out refinance. But on the buy side, by and large, we aren't seeing too much of a credit issue. Most of us have increased our FHA, VA, and rural development minimum credit scores from 580 to 620. I expect that to remain in place for at least another month or two until we get past most of this, until the states start opening up and we see how many people remain in forbearance. although the amount of people in forbearance has dropped a little bit, so that's good news. So again, I urge that anyone who's got a pre-approval, that I got pre-approved before all of this started happening, that they need to call their lender and say, hey, am I still pre-approved under the current rules? Just so there are no surprises once you go to put that offer in the house and all of a sudden you're no longer eligible for that mortgage. So for those of you who know me, I don't like surprises. So I try to cross my T's and dot my I's as much as I can. If there's any questions you have about the market, about programs, about clients that are no longer qualified where they were, to see if we can do that, please reach out to 487-705-8431 and have a great day.